distorted the market's projections for the Fed's tightening cycle. The collapse led investors to flee en masse towards the pressures, aiding to its ascent above the 1,900 key psychological level. In this report, we aim to shed light on the catalyst driving the precious metals price, assess future outlook, and conclude with a technical analysis. Market consensus about the Fed's hiking path forward radically changed since last week. Following Fed Chair Powell's comments, the market shifted their outlooks reflecting the hawkish prospects of the Fed, once the door for a larger magnitude hike sprang open. As a result, we saw the market shifting their projections, bracing for 50 basis point hike in the March meeting. As soon as the SVB's collapse headlines hit, however, the market quickly downgraded their projection for the 50 basis point hike and opted for a 25 basis point hike scenario, reverting to pre-Powell's peaked expectations. After the weekend, the Federal Reserve, FDIC, and the Treasury Department's joint decision to step in and ensure that depositors would get back their money back. We saw a complete 180-degree turn for the market, dismissing the 25 basis point scenario altogether and ended up pricing in that the Fed would stay on hold in the February meeting. Earlier today, the market was split equally between no hike and 25 basis point scenario in anticipation of the inflation report. The underlying message from this observation is that the market has no clue on what's to follow as we inch closer to Fed meeting and further developments from the SVB case alongside the results from the crucial US-related data may be needed for more accurate assessments. Bond yields were on a free-fall mode for the past 4 days, with the US 2-year yield nosediving in extraordinary fashion by more than 100 basis points, from 5.7% peak formed last Tuesday and finding support around the 4% level. Similarly, the benchmark US 10-year Treasury yield eased towards the 3.5% mark, down by more than 50 basis points for the same period. These erratic moves reflect the market worries for a possible spillover from the SVB's collapse into the entire banking sector, and as a result, investors fled to safety, diverting significant inflows towards the pressures. Hence, we observed gold's price pivoting from the low 1,800s and soaring past the key psychological level of 1,900 within 3 sessions, recording an incredulously 5.5% gain. Should fears for contagion persist and bond yields keep moving south, we may see gold price being propelled higher, closer to early February's peak. Earlier today, the latest US CPI print showcased that inflationary pressures have eased but remain well above the central bank's 2% target. Both the month-on-month and year-on-year headline CPI rates matched expectation, reported at 0.4% and 6.0% respectively. Confirming the slowdown, however, the core rate beat expectation and rose to 0.5%, above market expectation of 0.4%. And broadcasted once again the stickier nature of inflationary pressures. These results prior to SVB's collapse would have most likely pushed markets to expect the 50 basis point hike from the Fed. However, taking into account the fallout of the Silicon Valley Bank, the FFF currently assigns an 85% probability in the scenario where the Fed hikes by 25 basis points. The results had minimal effect on the greenback. However, the gold gained traction despite the jump of bond yields intraday and left analysts puzzled. Nevertheless, market participants will turn their attention towards Fed Governor Bauman's comments later today, who is conveniently the first Fed official to speak post the SVB mayhem and may drop some hints in regards to the Fed's intentions. Thank you for watching.